The stock market is not a casino, but if you don't understand how it works, you will behave like a gambler inside it. One person buys a stock because someone on social media said this one will explode. Another person buys a stock because they understand the business, the numbers, the risk, and the long-term opportunity. Both people click the same buy button, but one is gambling, the other is investing. So, in this video, I'm going to explain stocks in simple language, but at a deep level. By the end, you won't just know what stocks are, you'll understand how the stock market thinks. And the most important question is not, which stock should I buy? The real question is, what am I actually buying? Imagine your friend owns a fast-growing food business. The business is doing well, but your friend needs money to open more branches, buy equipment, and hire staff. Instead of borrowing from the bank, your friend says, I will sell small pieces of ownership in my business. You buy one piece. Now you don't work in the business. You don't cook the food. You don't manage the staff. But because you own a small part of the business, if the business becomes more valuable, your ownership can become more valuable too. That is the basic idea of a stock. A stock is a small piece of ownership in a company. Now let's go deeper. Most beginners think a stock is just a price on a screen. Red means bad, green means good. But that is a shallow understanding. A stock represents ownership. When you buy shares of a company, you own a small part of that company. If the company grows, earns more profit, expands into new markets, or becomes more valuable, investors may be willing to pay more for that stock. But if the company performs badly, loses customers, takes on too much debt, or investors lose confidence, the stock price can fall. Think of a company like a large cake. Each share is one tiny slice of that cake. If the cake grows bigger, each slice can become more valuable. But if the cake shrinks, your slice may lose value too. The first professional mindset is this: don't see a stock as a random price. See it as ownership in a business. But why would a successful company sell pieces of itself in the first place? Many people think companies sell shares because they are desperate. But that is not always true. Companies sell shares to raise money. This money can be used to build factories, open branches, hire staff, develop technology, pay debt, or expand into new countries. Instead of taking a loan and paying interest, the company can raise capital from investors. In exchange, investors get ownership. This is why the stock market is powerful. It connects people who have money with businesses that need money to grow. Imagine a tech company has a great app, but it needs 500 million to expand across Africa. A bank loan may be expensive, so the company sells shares to investors. The investors provide capital. The company grows. If the company succeeds, both the business and the investors benefit. The stock market helps businesses grow and gives ordinary people the chance to participate in that growth. Now that we know why shares exist, let's understand where people buy and sell them. Beginners often imagine the stock market as one big mysterious place controlled by rich people in suits. The stock market is simply a marketplace. But instead of buying tomatoes, clothes, or phones, people buy and sell ownership in companies. There are buyers, there are sellers, there are brokers, there are exchanges. The exchange is where the buying and selling happens in an organized way. If many people want to buy a stock and fewer people want to sell, the price usually rises. If many people want to sell and fewer people want to buy, the price usually falls. Think of a popular phone. If everyone wants it and only a few are available, the price can go up. But if nobody wants it and shops are full of it, the price may drop. Stocks work in a similar way. Price is affected by demand and supply. The market is not magic. It is people making decisions based on information, fear, hope, greed, patience, and expectations. But this leads to a big question. Why do stock prices move every day, even when the company looks the same? This is where many beginners get confused. They ask, if the company is still operating, why did the stock fall today? Stock prices move because expectations change. The price of a stock is not only based on what the company is today, it is also based on what investors believe the company may become tomorrow. If investors expect higher profit, stronger growth, or better future performance, the price may rise. If they expect trouble, competition, regulation, debt problems, or slower growth, the price may fall. Let's say a company announces that its profit doubled. Investors may become excited and buy more shares. Price rises. But if that same company says next year may be difficult, the price may fall even though the company made profit today. Why? Because the market is always looking forward. Professionals don't only ask, is this company good? They ask, is the future of this company better than what the current price already assumes? And this is where the stock market becomes dangerous. Because sometimes a bad company can rise and a good company can fall. Not because reality changed immediately, but because expectations changed. So how do investors actually make money from stocks? Most people think the only way to make money in stocks is to buy low and sell high. That is one way, but not the only way. There are two major ways investors make money. First, capital gains. This happens when you buy a stock at one price and later sell it at a higher price. Second, dividends. Some companies share part of their profit with shareholders. That payment is called a dividend. Not every company pays dividends. Some companies prefer to reinvest profit back into the business so they can grow faster. If you buy a stock for $10,000 and later sell it for $15,000, your gain is $5,000 before fees and taxes. But if a company also pays you dividends while you hold the stock, you can earn money without selling your shares. A stock can reward you through price growth, income, or both. But none of these are guaranteed. Now let's talk about the part most beginners ignore until it hurts them: mistakes. The biggest problem with beginners is not lack of money. It is lack of process. Many beginners buy because of hype. They sell because of fear. They follow strangers online. They put all their money into one stock. They expect quick profit. They panic when prices fall. This is how people lose money even in a market full of opportunity. One dangerous pattern is the pump and dump. This happens when people hype a stock, attract buyers, push the price up, and then sell their own shares, while late buyers are left with losses. Imagine someone says, this stock will rise 500% next week. People rush in, the price jumps, then the promoters sell. After that, the price crashes. The beginner who entered late is now trapped. If your only reason for buying is someone said it will go up, you are not investing. You are outsourcing your brain. So what do professionals do differently? Beginners look for stock tips. Professionals look for understanding. A professional studies the business behind the stock. They ask, what does this company sell? How does it make money? Is revenue growing? Is profit growing? Does it have too much debt? Who are its competitors? Is management trustworthy? Is the stock price reasonable compared to the company's value? They also think about risk. Even if a company looks good, they don't put everything into one stock. They diversify. A beginner says, this stock is cheap because the price is 5. A professional says, cheap compared to what? Compared to earnings, assets, growth, cash flow, competitors? A 2 of 5 stock can be expensive if the business is weak. A 500 stock can be cheap if the business is strong and undervalued. Price alone does not tell you value. Value comes from the business. Now let's make this practical for a beginner. After learning all this, a beginner may ask, so where do I start? Start with a simple framework. Learn, plan, diversify, and stay disciplined. First, learn before you invest. Understand basic terms like stock, dividend, market cap, profit, revenue, risk, and diversification. Second, create a plan. Are you investing for quick profit, business education, retirement, wealth building, or long-term growth? Third, diversify. Don't allow one company to determine your financial future. Fourth, control your emotions. The market will rise and fall. If every fall makes you panic, you may sell good investments at the wrong time. A smart beginner may start by studying broad market funds, strong companies, annual reports, and basic financial statements before buying individual stocks. They don't rush. They build knowledge first. The goal is not to look rich quickly. The goal is to make better financial decisions over time. So let's bring everything together. If this is already making stocks clearer for you, pause for 1 second and subscribe, because on this channel, we break down business, money, and investing in a way that actually makes sense. So, what is the stock market? It is a system where businesses raise money and investors buy ownership. A stock is not just a ticker symbol. It is not just a green or red chart. It is a small piece of a real company. Prices move because people are constantly changing their expectations about the future. Investors make money through price growth and dividends, but they can also lose money when they buy without understanding risk. The beginner asks, which stock will go up? The professional asks, what business am I buying? What is it worth? What can go wrong? And does the potential reward justify the risk? That is the difference. If you want a second video where I explain how to analyze a stock step by step like a professional, comment stock analysis below. And remember, the stock market rewards knowledge, patience, and discipline, but it punishes hype, greed, and ignorance. So before you buy the next stock, ask yourself one question. Am I investing in a business, or am I just chasing a price?